that show probably about 6, 7 months ago. We talked about how his company, Berkshire Hathaway, had stockpiled cash. Everyone's like, bro, he always does this. It's cyclical, man. You don't know what you're talking about. And now he's got an unprecedented level of cash just sitting on the sidelines.
So I have some of these figures for everybody. So we'll start off by saying no secret to anybody. He's one of the greatest investors of all time.
And if you doubt that, just stop talking to people about investing.
Yeah, okay.
There's undoubtedly no way to position him anything but one of the greatest, if not the greatest investors of all time.
Right, exactly. He's got a famous rule. Rule number one, when it comes to investing, don't lose money.
I kind of like that rule.
That's a very good rule. And then he's actually got a second rule to that. Rule number two, don't forget rule number one.
So it's Fight Club.
Yes.
Yeah, it's him, Brad Pitt.
Yeah,
in Fight Club.
Exactly. So the last time he even came close to piling on this much cash was in 2005.
Wow. So are you trying to intimate that he maybe saw some of the metrics leading into what became the Great Financial Crisis?
I don't think that that was the case per se. I very much think that him and his team over there at Berkshire Hathaway are constantly looking for good deals, right? They want good buys. And if there's no good deals to be made, he won't jump in.
Let me color that a little differently because I think you're right. But I think him and his team are very cautious about pulling your chips out when valuations are high.
Mm-hmm.
I think they're probably looking at the market right now saying, okay, the market is overvalued. Now we've got more downside risk than upside risk in some of these stocks. So let's sell out in cash, hold cash until we can find something that's got a viable entry point from a purchase perspective.
Absolutely.
And I think as he's sold out of those positions that he feels are more top of market than bottom of market and only downside risk or more downside risk than upside, he's probably saying to himself, I don't see an opportunity to buy right now and utilize this cash and put it to work. So I'm going to put it into Treasuries. I'm going to put it into something that gives me a decent yield near term while the market gives me an opportunity. Why rush it? And that just so happens to coincide with his strategy leading up to the Great Financial Crisis, not because he predicted it, which he really didn't do, but because he was tracking metrics which should have predicted it.
Absolutely. Exactly. So the question that is going around is should we all take this as a warning sign? Because one other thing that him and his team did over there is they completely sold off of both of their S&P 500 ETFs.
I saw that, and
that's the part that has everybody talking.
That really rattled me. I was driving into work, and I used to be like listening to music on the way into work and kind of,
yeah, me
rocking
too.
out.
And that just completely has changed for me.
I think we're old now. That's what it is. I think that's like the barometer for old. Like once you drive into work and you're listening to like CNBC or a podcast, you're old.
I feel like even the young people, the young generation these days, they're listening to podcasts now too. I feel like that's got to be a dying. Like, who's really rocking out to some Linkin Park, Jay-Z on the way to work now?
Damn, why you got to go there, bro?
I'm just saying, feels a little aggressive, right?
It is a little hard for 9 a.m. in the morning.
I mean, some people 7 a.m. in the morning.
Yeah, if the sad part is most of my music listening to these days, if I'm not working out, it's like rain sounds, like rainforest sounds, like birds chirping and like rain, and I'm in my mind going,
"You're lying."
No, when you come to my office and I have AirPods in.
So you're working out, you're listening to rain sounds?
No, except for that time.
Oh, except I see. Okay.
Yeah, I'm usually listening to Barbra Streisand when I work out.
No, Run the Jewels.
Right, I do listen to Run the Jewels a lot.
Right?
Yeah, I'm a Run the Jewels guy.
Yeah,
gotta love Killer Mike.
You have to.
He's gangster.
He's friends with Bernie.
Yeah, he knows.
He knows.
Yeah. I think that was very symbolic for me. So I was driving into work, and I hear this as a byproduct. I listen to CNBC sometimes in the mornings, depending on how action-filled the morning is, or if I know that some reports are coming out that I want to hear. And I do a little podcast on financial literacy, so I try to stay up to date. But that was one of those headlines where he got out of VOO and some other like S&P 500 funds, and I thought to myself, like, okay, so if he thinks that's overvalued, it's got more downside risk than upside risk. Because really, that's as simple as his logic is. It's not complex. I'm thinking to myself, like, oh my God, should I sell down my position? Like, should I get out? And then I'm like, you know what? For him, let him be intelligent. I'll just dollar cost average my way through this.
There you go.
Whatever it is.
So when people are referencing that they're sitting on the most cash they've ever sat on, okay, let's get into some of these figures. They're sitting on over $334 billion in cash. or cash equivalents.
Yeah.
Okay.
Treasuries.
Exactly. It's got 286.5 billion in UST bills,
Mm-hmm.
right? And 44.3 billion in cash.
Yeah. And just to be clear, it's not as simple as him just holding those in like one account.
Yeah.
They usually have some type of interest rate risk policy. They have a liquidity policy. They're hedging for inflation, not necessarily by hedging for like the valuation of currency, but they're hedging for interest rate risk and duration of the assets. They're timing things out in shorter and longer duration. So they have money tied up for longer, earning more, but tied up for shorter, earning a little bit less. And the average duration on both gives them an average yield, which is better for the market. So there's a lot of liquidity management strategy in that. It's not as simple as that, but the market goes, "Oh my God, he's dragging 300 something billion dollars in cash," and it's to me it's very telling. And I do worry that, like we talked about in the previous show, there is an asset bubble. I can't tell you what it is, but there's clearly bubbles that are out there. And now I think more than ever, you're starting to see the cracks, whereas before you didn't. The housing market, I mean, if interest rates went down 50 basis points, granted, it's a lagging indicator, so time could tell. But if you're at historic low applications for new mortgages, like that's telling. And then I go, okay, well, wait a minute, what else is going on? And I'm like, well, the crypto world's been a little on fire lately.
79,000.
Yeah, Bitcoin went from above 100,000 down to below 80,000 again. That's a big swing, and I have yet to see a clear and concise explanation for why that value swing. Oh, did you see the statement by the SEC today?
No, I did not.
Oh, let me drag this up. Hold
Okay.
on.
Drag this up because I also wanted to wrap up our conversation about Mr. Warren Buffett.
The Mr. Warren Buffett to you, sir.
The Mr. Warren Buffett.
Yeah.
Another notable point that has been made around this entire topic for them is that in the last quarter, in Q4 of last year and Q1 of this year, they didn't buy back any Class A or Class B stock as well. So what does that mean as far as their position in holding their cash? What kind of signal is that sending if they haven't bought back any of their own stock with the cash that they held on to?
First of all, their stock price is high. So they don't really need to take more of their stock off the market to improve valuations. Typically, when companies do that, they're trying to signal the strength in their position and trying to increase the value of their underlying stock. And they're redeploying their retained earnings and capital into buying stock back, saying that we're confident in what we're doing here. And it has a really good benefit to the market. It tells the market you believe in you, right? But if you're in his position, number one, your stock price is already high. It's one of the highest stock prices out there. You're also saying, you know what, I'm going to redeploy this money into something, and there's an opportunity coming. That's what he's effectively saying. If I buy my stock back, yeah, all well and good, but I'm also missing out on upside potential on opportunities that I could be buying into. And there's really no need to continue to price people out of a stock that is very, very, very expensive. All right, so the SEC made a comment about meme coins particularly, but I think it's very telling